The cattle market didn't move much today, but something happened over the weekend that could change where it goes next. Not because of a chart, not because of a report, but because of what burned. Fires moved through Nebraska. Grass gone, fences gone, and for some producers, their plans for this year are gone with it. Now, in most years, that's a regional issue. It's serious, but it doesn't reshape the entire market. This year is different because we're already operating with one of the tightest cattle supplies in decades. And just as the conversation started to shift toward rebuilding, this hits. At the same time, energy costs just surged. Fuel is climbing, fertilizer risk is building again. So now you've got two forces starting to pull at the same time. Supply tightening in cattle and rising costs across the rest of agriculture. The market hasn't fully reacted yet, but producers are starting to adjust. And the real question right now is, did Nebraska just lock in tighter cattle supplies longer than anyone expected? Right as the cost of farming starts climbing again? Because that's where this is headed. This isn't just a weekend story, this is the start of a shift. This is Boots and Bushels, your daily look at the markets that feed America. Today we're leading with the Nebraska fires and what they could mean for cattle supply moving forward. Then we'll move into grains, where prices are steady, but margins are starting to shift underneath. We'll break down energy and fertilizer because costs are starting to move again. And we'll expand into the biggest ag news stories right now that could shape decisions this spring. Let's get into it. We're not starting with the board, we're starting with reality. Nebraska saw widespread wildfire activity over the weekend, and this wasn't light damage. Large areas of grazing land burned. That means grass that was supposed to carry cattle is gone. Fence infrastructure is destroyed. And in some operations, livestock losses. Now here's the key. Grass is time, it's feed, it's flexibility. When it disappears, so does optionality. Producers don't get to wait and see, they have to act, and those actions reshape supply. When a producer loses grazing capacity, there are only a few paths forward. Move cattle, sell cattle, or reduce future plans. Moving cattle sounds simple, but it isn't. It means finding available pasture, paying transportation, adjusting feeding programs. Selling cattle pulls supply forward. It increases near-term availability, but reduces what's available later, and reducing herd plans extends tight supply further out. Every one of those outcomes leans toward less supply down the road, not more. Now put that in current context. We're not in a surplus environment, we're in a tight one. Years of liquidation, drought pressure, high feed costs. All of it has brought the U.S. herd down, and recently there were early signs of stabilization. Not expansion yet, but the idea that we might be approaching it. That requires confidence, it requires grass, it requires stability. And events like this interrupt that. Live cattle last trading near $233.28. Feeder cattle near $355.03. Nothing explosive, no sharp move higher. And that's what makes this important, because the market hasn't fully reacted yet. Cattle markets don't move instantly on events like this. They move in stages. Event, assessment, behavior change, then price adjustment. We're between stages 1 and 2. The event is known. The full impact isn't. That creates a window where price doesn't reflect reality yet. Even if the total loss number isn't massive, behavior shifts are. Producers who were thinking about rebuilding pause. Those holding cattle longer rethink. Expansion gets delayed. And when expansion gets delayed, tight supply stays tight longer. That's the real shift. Corn is trading near 453, soybeans around 1214, wheat near 594. At a glance, nothing dramatic. But markets don't just move on price, they move on economics, and that's where things are shifting. Crude oil's near 94.70, a sharp move higher, and that matters because energy drives fuel, fertilizer, and freight. When oil moves, everything connected to production moves. Not immediately in price, but in cost. We're starting to see early signals of fertilizer pressure building again. Global supply chains are tightening, energy costs are rising, and that combination pushes fertilizer higher. Higher fertilizer costs don't just increase expenses, they change decisions, application rates, crop choice, risk tolerance. Corn is input heavy, beans are less so. So when fertilizer rises, corn becomes more expensive to grow. Beans gain relative advantage. That doesn't mean acres shift overnight, but it sets the stage, and markets move ahead of that shift, not after. To fully understand what's happening, you have to zoom out, because Nebraska isn't the only pressure point right now. Brazil's safrinha corn crop is facing uneven conditions, late planting, moisture variability, and compressed growing window. What this changes is global corn supply expectations become less certain. And what to watch, weather consistency over the next 30 to 45 days. China's been active but inconsistent in grain buying, not aggressive, not absent, just unpredictable. What this changes is export demand lacks clarity. And what to watch, any large purchase announcements or cancellations. Tension in the Black Sea continues to create uncertainty around export. That changes wheat and corn supply reliability. Now we watch shipping disruptions or policy changes. In farm economics, rates remain elevated, borrowing costs are still high. That changes operating loans, expansion decisions, equipment purchases, and what to watch, any shift in Federal Reserve tone. So the big picture is this. This is not just one story, it's multiple pressures stacking. Cattle supply tightening, energy risk, fertilizer risk building, global uncertainty, weather instability, individually manageable, but together they create tension. So we're going to keep an eye on cattle damage assessments, fertilizer pricing movement, energy follow through, acreage expectations, and weather escalation. Because if these align, the market moves. Right now, nothing looks broken, but the structure underneath is shifting. Cattle tighter, cost higher, risk building, and the market hasn't fully caught up yet. That's where opportunity begins and where mistakes get made. If you want daily updates on the markets that feed America, subscribe to Boots and Bushels. We'll see you tomorrow.